Right, so the SPX. 90% of traders, they actually lose money trading the SPX. And that's because they don't understand how it works, how it's calculated, and why it moves the way it does. So if you've ever wondered, is the SPX a stock? Is it an ETF? Can I trade it directly? This video will clear everything up. So by the end, you'll understand how it moves, how it's constructed, and how you can sort of utilize it in your trading. Right, so let's make this quite simple. Let's start off with the basics. SPX is just a shorthand for the S&P 500 index level. It's not a stock and it's not an ETF. It's just a calculated index level, and essentially it represents the combined performance of the 500 largest US companies. So think of it as a sort of scoreboard for the US economy. Now, this is where people sort of get a bit confused. You can't just open your broker and click buy on the SPX, because the index itself isn't directly tradable. It's just a number. But what is important, you can trade products that are related to SPX. For example, ETFs like SPY or VOO. They track the S&P 500 and essentially trade like stocks. ES or MES, the futures, again, they mirror the index and trade nearly 24 hours a day. And of course, we have SPX options, the cash-settled derivatives on the index level itself. Very popular with institutions because of the size and sort of tax treatment that you can get. So SPX is the scoreboard. The ETFs, the futures, and the options are sort of the ways you can trade this index. So now that we've covered the basics, we're going to go into why SPX matters, why it's important for traders and investors. So the S&P 500 index was actually launched in 1957, and before that, most people were trading the Dow, and that only tracked 30 companies. So the S&P 500 sort of changed the game because you can now track 500 of the largest US companies, and it gives you a sort of more complete read on the entire economy. And then SPX sort of became the world's default benchmark. Pension funds, mutual funds, sovereign wealth funds, hedge funds, robo-advisors, so many of them either try and beat or match SPX's yearly returns. So the S&P 500 as a whole, trillions are benchmarked to it, and essentially trillions more flow through it through funds that mirror it. So the SPX has sort of been the reference point for a lot of events that have occurred. Dot-com bubble, 2008 financial global crisis, SPX fell more than 50%. The COVID crash in 2020, SPX pulled back by 34%. And then in a month, nearly doubled its price, which was one of the fastest recoveries on record. And then, of course, the post-2020 bull run, led by the megatech and liquidity. So why is this important for traders? Because when someone says the market's up, they're essentially referring to the SPX level being up, the index level. So if you manage money, if you trade actively, or if you just care about the markets, the SPX is that indicator that tells you how the economy is performing. So SPX isn't just a chart, it's essentially the standard that the financial world measures itself against. Right, so now that we've covered that, we need to understand how the SPX is built and how it's constructed, how it's calculated. So under the hood, the S&P 500 is not just a random list of stocks. It's market cap weighted. And all that means is the bigger the company is, the more influence it has on its price. So we have the top 10 companies at the moment: Nvidia, Microsoft, Apple, Amazon, Meta, Broadcom, Alphabet Class A, Alphabet Class C, Tesla, and Berkshire Hathaway. These are the top 10 companies in the S&P 500. And these 10 companies make up over 38% of the index's total weight. So essentially, if we know that these companies are moving, or if these companies are rallying in a certain direction, this will carry the index in the same direction, even if the other couple hundred of stocks are stagnant. So on one side, you've got the mega caps, massive, heavy weighted companies, huge companies. And on the other side, you've got the rest of the index. So no matter how small or large the other companies are, it's always going to be the mega cap, the big players that tip the index level. And this is why serious traders, they often compare the SPX level to the RSP. And the RSP is just an ETF that essentially gives you an equal weighting of the S&P 500. By equal weighting, I mean that every single company has the same weight and value. So essentially, Apple will have the same weight as the 500th company in the index. So it sort of strips away the dominance of the mega caps and gives you the sort of read on what the average stock is doing. Right, so I just opened up the charting, and on the left-hand side we have the SPX, and on the right we have the RSP. So the SPX, like I mentioned, is market cap weighted. The heaviest companies, the largest companies, control the majority of the weighting. The RSP is equal, which means every single company in the 500 index has an equal weighting, which is why at certain points the RSP looks like it chops more, which explains the price action on the RSP that we can see. When mega cap companies lead the rallies, the SPX often rallies, hence what we're experiencing currently. It's often very, very good to compare both charts to see which sector is sort of leading, and if there is a sort of sector rally, specific sector rally. So what moves the SPX on a day-to-day basis? And it essentially boils down to two things: earnings and valuations, and sort of the macro elements that affect these. So earnings are just the company's profits, the collective profits of the 500 companies. If these profits rise, the S&P 500 index level will rise as well. And the multiple is often referred to as the PE ratio, and it's just how much investors are willing to pay per dollar of earnings. So the multiple actually expands when the outlook is confident, or essentially when rates are low, and it sort of contracts when fear increases, when rates are high. So think of it in a simple term, very simple calculation. The index level, the SPX level, is the earnings multiplied by the valuation multiple. And of course, these factors are determined by the macros. So we have the interest rates and yields. If we have high interest rates, this compresses valuation multiples, which is bad for the SPX level. And of course, if we have falling interest rates, this is often a very good thing for the SPX. We have inflation, again linked to the interest rates. Hot inflation can pressure margins, push up rates. Cool inflation can essentially ease both of them. We also have the US dollar. So a strong dollar will actually hurt multinational companies abroad. Their profits can get affected when they're converted back into the dollar. And of course, we have the growth rate, GDP, jobs, ISM. Essentially, surprises here can lead to changes, massive changes in the earnings and Fed policy, linking back to the interest rates again. So this is why Fed days, CPI prints, job reports can cause massive moves in the SPX level. So earnings, valuation, and macro, they essentially determine how the SPX moves. So now that we understand how the SPX is calculated, how it moves, it's important to know why traders watch the SPX and understand the gap problem that we have. So traders treat the SPX like a risk indication. When SPX is trending up, correlations tighten, everything else often rallies. When SPX breaks support, many traders rotate or pull back from the markets. And we also have the timing issue. So the SPX index level, it only updates during the cash hours, which is 9:30 to 4 p.m. Eastern. And it doesn't actually print pre-market or after hours levels. So if big news hits at 8:30, for example, CPI, you won't be able to actually see it on the SPX chart. So you'd have to look at the ES futures chart because that trades in only 24 hours. And only until 9:30, you'll see the SPX open, and then you'll see a gap in the chart, which shows the difference in the price movement. So if you're sort of analyzing overnight reactions, or you want to see real responses to data, you need to be looking at the ES chart specifically, and then switch back to the SPX chart for the trading. So sort of SPX sets the tone during the cash hours, and ES sort of shows the overnight price. So we know that the S&P 500 was actually created for investors originally, and then eventually the trading products that came off of it were sort of more suitable for traders. But why do investors care about the SPX? So for investors, the SPX is sort of the foundation. Historically, including the dividends, SPY has returned 10% on average every single year over many decades. Of course, it's not a smooth line. Some years, there are massive withdrawals, 20, 30, 40%. But over a longer period, the SPX compounding has been very powerful. And now a huge part of that, it does come from the dividends. Now, this is something you need to understand. SPX does not pay dividends. It's just the number, it's just the index level. But the ETFs that track it, for example, the SPY, they do pay dividends. So essentially, investors that invest in the SPY are able to reinvest the dividends that they get for holding long term. Now, let's talk about the sectors, because sector leadership is huge with regards to the SPX. Technology is often the biggest slice, over 30% of the index. Of course, we were mentioning before the mega caps. A lot of the top 10 are tech companies. Even if a lot of companies in the index are lagging, if the technology sector is rising, the SPX will rise as well. Then we have healthcare and financials. They usually sit near the top of the weighting as well, and they're also critical for medium-term trends. And of course, we have the energy, industrials, consumer discretionary, and they sort of rotate during the year. So if tech is weak while the energy and utilities rally, the SPX actually might chop or underperform due to the weighting. If tech rallies, the SPX will also rally and often outperform the RSP. And that's why it's important to always have a quick check between the SPX and the RSP, and also compare the sector differences. For example, the XLK, the technology, XLF, the financials, the XLE, the energy. It can really tell you what's sort of pulling the index and which sector is driving the index up. So we cover the history, why it works, how it moves. But there's a lot of common misconceptions with the SPX. I just want to clear up in this slide. So number one, is SPX a stock? Like I mentioned before, no, it's not a stock. It's an index. It's sort of a calculation level. Number two, can I buy SPX directly? No, you can't. You cannot buy SPX directly because it's an index level. But you can buy SPY, VOO, which are ETFs. You can trade the ES or the MES, which are futures. And you can trade SPX options. Number three, does SPX pay dividends? The index does not pay dividends, but ETFs tracking it do. And those dividends are very important for long-term growth. Does SPX trade pre-market and after hours? No, it doesn't. Like I mentioned before, we have the gap issue. If you want to see the overnight action, you have to be looking at the ES chart because that trades nearly 24 hours a day. Does SPX cover every market? No, it doesn't. SPX only tracks the large cap US stocks, the top 500 US companies. It leaves out small caps, it leaves out international companies, it leaves out bonds. I hope that sort of clears up the misconceptions beginners have with the SPX. If you have any additional questions, do leave them in the comments and I'll get back to you. So as a summary, SPX is very powerful, but you have to understand how it works and why it works the way it does. So I've just opened up the SPX again on the chart. And I'm actually looking at the daily chart. So you can see here, back in 2020, COVID crash, the price actually fell 34%. But just look at the rebound. It almost doubled in less than 2 years. Liquidity, stimulus, and sort of mega cap tech leadership led the rally into all-time highs. And now currently at the moment, we are rallying into all-time highs once again. So as you can see, the sort of slow growth over the years, the SPX has slowly increased its level due to the massive growth in tech companies and the S&P 500. So having just looked at the chart, it's important to understand the practical uses of SPX. So here's how to make SPX sort of useful immediately, whether you trade or invest. Daily baseline. Start your sessions understanding if the SPX is in a trend or not. Are we above or below the 250 moving day averages? Are we in a trend? Are we in a range? Are we chopping? These are really important before you start your trading day. The breadth check. Compare SPX to the RSP. If SPX is strong but the RSP is lagging, mega caps are essentially leading the rally. Sector drivers. Have a look at the XLK, the XLF, the XLE, the XLU. Which sectors are sort of pulling up the index? Macro watch, very important as well. The 10-year yield, the US dollar, the Fed calendar, these all shift the valuations and sort of the sentiment that can cause huge volatility in the SPX level. Event days, again, 8:30 data, watch the ES first, then at the open you can see the SPX level and how it reacts in the cash hours. So sort of build this into your routine and SPX can become a very, very powerful signal.